It has been a dismal start to the year, with equities coming off their worst first half of the year in 5 decades. It may come as no surprise that popular vanilla equity ETFs were mixed and money poured out of the core bond funds. The iShares Core U.S. Aggregate Bond ETF alone tumbled 10% from January through the end of June. But not everything suffered. Dividend ETFs were among the big winners as investors sought steady returns. Joining us now is Will Ryan, CEO of Granite Shares, and Todd Rosenbluth, head of research at VettaFi, and Michael Sonnenschein, CEO of Grayscale Investments. Todd, I'll start with you. Right now, growth is falling to the wayside, and there's a lot of talk about 2022 being the year of the dividend. Are you seeing that story play out so far?
We certainly are. We're seeing near record inflows to dividend ETFs, close to $50 billion in the first half of the year. And what we're seeing is that advisors are increasingly looking to dividend strategies as a form of income. We recently did a survey of advisors at VettaFi, and dividend strategies were most popular in terms of getting income, higher than corporate bonds, higher than treasuries, higher than more narrowly focused sectors like real estate. We're seeing dividend ETFs like HDV, which is the high dividend yield ETF from iShares, be popular. We're seeing Schwab US Dividend ETF also gain traction. That's a more dividend growth ETF. But what we're also finding is that advisors are doing more homework to understand the differences between ETFs. So, for example, HDV is heavily weighted towards a handful of sectors, including energy and healthcare, but a more diversified high dividend yielding ETF. The ticker is SDOG. It's the Alps Sector Dividend Dog ETF. That's more equally weighted across the sectors. So it's important to do the homework and understand the differences between these dividend ETFs, but they're really gaining traction this year.
Yeah, and you're also seeing a lot of activity around ultra short-term bond ETFs as a safe haven play. Tell us about that.
That's right. So this category, which is as less interest rate sensitive as you can get within the fixed income universe, they're not cash, but they're cash-like strategies, duration or interest rate sensitivity less than 1 year. You've got ETFs that are index-based under the ticker BIL, which is a State Street product. You've got actively managed ETFs like JPST, which is a JP Morgan product. Collectively, these ultra-short bond ETFs have pulled in $25 billion. For perspective, they only have $75 billion overall. So, I'm sorry, $95 billion overall. So we're seeing this asset base grow significantly, and it's another one of those trends we're watching here at VettaFi.
Will, any thoughts or reaction to these dividend short income plays?
Yeah, no, I think it's understandable in the sense that a lot of dividend stocks tend to be synonymous with more value plays, and that's clearly been, the theme in equity markets, or one of the main themes in equity markets this year, is people getting out of growth names that typically don't pay much of a dividend, if anything at all, and into cash yielding names such as these value stocks. I think that's something that we've seen in our own business on the income side, that people are really prioritizing cash, and obviously potentially coming into a recession, that's going to be a lot more important.